This is Austin Real Estate Investing.
Austin Real Estate Investing.
We'll be discussing real estate investing in Austin, Texas, and bringing you experts from all different sectors of the real estate game. Your host, Jordan Moorhead, is a real estate agent and investor in Austin and is here to help you get started or to build your portfolio and explore new strategies.
Hi, this is Austin Real Estate Investing. This is Jordan Moorhead. Today we have Mark Hentemann, and he's going to be telling us all about his experience investing in real estate and what he's doing in Austin right now. How's everything going with you today?
It's great. How's it going with you?
Good. It's a little cloudy here in Austin. I don't know what it's like in LA, but a little gray today here.
It's sunny here. I just got out of a writing session and my girls are outside the window. Hopefully I'm not too loud playing in the backyard. So yeah, all good.
All right. So real quick, Mark, tell us a little bit about who you are, what you do, and how you're involved with real estate investing.
Okay, sure. My name is Mark Hentemann. I am a real estate investor and also a writer and producer in television. I've been one of the original writers on the show Family Guy. I've written movies. I ran Family Guy, have created a couple shows for Fox and MTV. And basically, when I got to LA, I was terrified of the entertainment business. And so I, in a roundabout way, with my first couple script payments on a brand new show called Family Guy, I invested in a duplex, and that got me started in real estate. And, I unexpectedly got completely hooked on it and have done that concurrently with my writing career for the last 20 years.
That's awesome. So you started with the duplex. When was that first duplex?
A little bit of my trajectory. I'm from Cleveland. I'm from Ohio, and I moved after college to New York City and was completely broke living in New York. I thought it would be fun to try to get into the writing business. And, so I spent some traumatic times there, at least like bolting awake in the middle of the night, panicked over how I was going to pay my rent. And I realized that this is a rocky business and a tough business. But when I got out to LA, I ended up writing for David Letterman in New York, and then moved out to LA with my fiance at the time. And I started on this new show called Family Guy back in 1999. And, none of us thought it would survive. We thought it was, going to last about 3 months and we'd all be unemployed. So with my first couple script payments, which I had like $45,000 total. I think I got paid like $23,000 an episode. I went wandering into an open house on one Sunday, basically because my landlord had raised the rent on my 1-bedroom apartment, and talked to this broker. And she was like, if you've got $45,000, why are you throwing that away on rent when you can put that towards the mortgage? And I was like, a mortgage, like that seems like the worst thing I can do, because I can be unemployed. My show could get canceled tomorrow, and probably will. And I could be out of work for the next 6 months or maybe even a year. And you think I want the responsibility of a mortgage? And she kind of argued and made some points. Oh, it could be an investment. And I was like, well, an investment, like, yeah, that sounds attractive, but what about the risk associated with it? And anyway, I said, the only way I would ever take out a mortgage is it would have to be the best investment I have ever made. It couldn't be a cute house that's overpriced. It would have to be something that could give me a financial cushion that I was desperate for. And she must have had slow traffic that day at the open house, because we talked for a little while. And then I left and I figured I'd never hear from her again. But she called me 2 weeks later and said, I found the property you need to buy, but there's a catch. You need to become a landlord. And I was like, a landlord? That doesn't sound fun at all. But I met her at the property and it was run down. It was kind of run down. This charming architecture buried by overgrowth and peeling paint, and it was, but it was in a good location that was up and coming. There was still graffiti on the sidewalks of this street, but it was very close to a place called Larchmont Village, which had a ton of great restaurants and coffee shops, and it was walkable, had a farmer's market that everybody seemed to go to. And finding a walkable place like that where you don't have to drive on the weekends, you could just walk everywhere, is a big thing. So I could tell that it was good. I could tell that it was an up and coming neighborhood, but just a unkept property. The owners, I remember the sellers were leaving because they were going to move to Kansas and dig a hole and build an underground house and live off the grid. And they were raising goats and chickens in the backyard of this house in LA, in the middle of central Los Angeles. But it was interesting to me, and I was a little bit tantalized by the prospect of getting this investment and having something that could provide a cushion. But I was also terrified, and there was also 15 other buyers at the time, and we got in a bidding war. And I think the first couple of days, I'm like, well, what do you think? And this broker was like, I think you should go for it. I think this is a really good price. And I think, if you fix this up, you'll do really well for yourself. So I sort of half trusted her, wasn't really sure, but went on a roller coaster ride of a bidding war where the price was going up $15,000 daily. And, I had offered $350,000. It was listed at $379,000. And we went up, the bidding went up every day. And after about 2 weeks, I won the bidding war and paid $435,000 for this property. Wow. And thought I had just made the biggest mistake of my life and that this was going to bankrupt me. And I would be digging myself out of this hole for years to come. But yeah, I tried to embrace it and moved in. My first tenant was a guy named Mike Henry, who is a voice actor and writer on Family Guy. He does the voice of Cleveland and Herbert and Consuela, if people know the show.
Yep.
And yeah, I mean, he used to make fun of me for being a landlord, and I used to threaten to evict him, pretty much on a weekly basis. But I was also convinced that I had made the worst mistake of my life buying this thing. So I was reading books and trying to learn about real estate and trying to dig myself somehow out of this hole and try to survive this thing. But yeah, so I owned that, and I sort of think about it in this way that in year one, I thought I had made the biggest mistake of my life. In year two, I refinanced, and at the time the rates were going down. So I think I might have gone from a 7% interest rate, which, you don't see that anymore, down to maybe like a 5. So I went down quite a bit. That allowed me to get out of PMI. If you guys know what, if your listeners know what PMI is. And then in year 3, Mike Henry moved out. My tenant moved out. I was able to raise the rent about $450. And I thought real estate was the greatest thing in the world. So I did a complete turnaround, and I was like, I have to do this for the rest of my life. And started buying other buildings, was always salivating over I was in a duplex. I was always salivating over the fourplex across the street. And, then even the sixplex next to that, I was like, oh man, if you had 6 units, one of them goes vacant, you still got 5 more that could cover your mortgage. And so I was very tuned in and a believer in economies of scale. And yeah, and I basically owned that first duplex for 5 years. I bought it for $435,000. It was listed at $379,000. and I sold it for 1.27 million.
Whoa.
And I caught a good upswing in the market. I got to say, I also, renovated it. And it really enjoyed the renovation process as well, because I think partially, I'm in the world of abstract ideas all day long in writers' rooms, and it's easy to get in your own head and trying to figure things out. And you don't know if it works or if it doesn't. But it was fun to come home and after work, and just real estate was so palpable, so concrete. It was there.
Yeah. So how much did you put down on that first property?
I was unaware of the FHA loans, but I did get a 10% first-time buyer loan. And so I put down $43,000.
Okay. So that,
and I think, go ahead.
43,000 turned into a little over 800,000.
Correct. Exactly. Yeah. And it turned into, I think, like 830,000. Mm-hmm. And then I went to and I had been reading, my sort of self-education that I was attempting to do, caused me to go to my CPA. And I said, hey, I have an idea about this duplex, and maybe this is a common thing that everybody does. But I said, can we take the primary residence, married couple, $500,000 tax exclusion on our side of the duplex. Mm-hmm. And then can I also 1031 exchange the rental side? And they said, yes, you can. And so we pulled out $500,000 and then took the rest of our proceeds, which was about like $350,000, and put it into, I think, a 16 unit in LA.
Oh, awesome. So real quick, just to explain some terms for everybody listening, PMI is private mortgage insurance. You have to get that on anything where you put down less than 20%. On a loan like Mark's, if he would have paid it up to 20%, that would have gone away. But since he refinanced, he just got out of it anyway. He obviously refinanced into a loan where he had more than 20% equity in the property. But another term we just mentioned was a 1031 exchange. That's a tax-deferred exchange. Essentially, the government's saying you can pay taxes later if you reinvest that amount of money into a larger property. So they're assuming that later on in the future, you're going to pay more taxes than what you would have paid had you paid taxes on that property you were selling. So they let you send that into a bigger property, make more money out of that, and then pay them a bigger chunk when you sell that property. That's their thought process.
Right. Deferring, mm-hmm. Basically pushing your capital gains exposure or bill down the road.
Yeah. Yeah. I love that stuff. So the first property you bought was a duplex. What came after that? I know you 1031 into a 16 unit, but.
Yes. I think in the meantime, while I owned that, I was starting to get to know brokers, and I bought a fourplex, a 4-unit building, not too far away. It was in prime Hollywood, mm-hmm. but really kind of another rundown property. Mm-hmm. And yeah, I think I bought another fourplex out of foreclosure before I bought the 16 unit. So I was just adding, and it was always, I think, like, there's so many things that I did on my first deal that I would never do again. And just like I evolved a criteria, and I evolved like what I'm looking for, because I didn't know what I was looking for on my first deal. And ironically, this will be, ironically, that first deal, I made about 2,000% return on my equity, and I will never touch that. Like, I can never duplicate that. And I haven't certainly done a 2,000% return. And primarily I got that, exaggerated return because I got 10% down. I've never had that kind of leverage. So as a result, I've never had that kind of gain.
Yep. And I want to touch on that real quick too. I think a lot of people don't realize how powerful those low down payment loans are. Yeah, you do have to live in the place. You put down less than 25% on a multifamily property, you need to live there. but the returns are exponential compared to what you would get if you put down 25%. Because let's say you're putting down 3.5 or 10 or 15%, you get such a higher return when you go to sell that property. So, Mark put down 43,000. If he would have put down 100,000, and that 2,000% return would have dropped it only about 1,000% return. Still really, really good, but not as good as you got with that low down payment.
Right. Yeah. And another way to look at that is if I paid cash, I would have, bought this $435,000 property and gotten the gain on 1.27. So it would be roughly like a 3x on the money, but with 10% down, that makes 10x is your gain. So it was 30x. Yep. And then it's not quite that what happened in reality because I had expenses and stuff like that. But, leverage is powerful if you use it, carefully.
Yeah, I love that. I think that perfectly illustrates the point of leverage right there. So, the difference between putting down cash, which is really safe, but you're not making as high of a return on your money. I think people get confused. They say, well, I'm making a higher cash flow every month, but you can grow your money exponentially if you use leverage safely and effectively.
Yeah. And I don't know if this is getting too much into the weeds, but as I evolved my strategy, and like I said, I never used the same strategy, which with that first deal afterwards, and what that strategy was on that first deal was just guess and hope the broker wasn't steering me wrong. And thank God she's awesome. Her name was June On, but she steered me right. And she was right about that property. And we've been friends ever since. But after that, I was, studying and evolving like this strategy for investing in real estate. And I didn't know at the time, like now that social media has become a big presence in the multifamily space, I didn't talk to another multifamily investor for probably like 6 years of my first investing. So nobody told me you couldn't invest in LA or in coastal markets. It was just where I was. And so I was always looking, my criteria became, I looked for the cheapest, the lowest cost per square foot. Like that was the metric. And as your investor, listeners may experience, and you as well, like I would get a little exasperated when I was combing through a lot of properties, and LA has, thousands of properties to look at. And, it had a cap rate, and okay, the cap rate's pretty good and the GRM is pretty good, but the cost per square foot is really high. And like, there's these 3 or 4 metrics that you could look at on these properties, and none of them were all going to be great. You were never going to see a great, a high cap rate, a low cost per square foot, a low cost per unit, and a low GRM. So I was like, how do I decide? Because I kept looking at these properties, and then I'd see like, okay, well, 3 of the metrics are great on this, but the 4th one is really bad. Like for example, the cap rate is high and strong. The GRM seems good, but the cost per unit the cost per square foot is really high. And I was like, well, what is that? Why is that? And if you get experience, you realize that what that tells you is that that's probably a newer product, and they're achieving good rents, but you're paying a lot. And where one of the things I zoned in on is I knew that most properties in LA sold from like the lowest was around $250 a square foot, and the highest, could go up in the 700s, or there's $1,000 a square foot in some coastal areas. So I became a fan of low cost per square foot, because what that told me is you're buying just the asset itself for a very discounted price. And it was probably a value add. And so because I wanted a value add, and then And then that got me over that first hurdle of like, how do I choose the property? Is like, okay, if it hits my criteria for low cost per square foot, then the next thing I go to, where is it? And if it's in an up and coming location, that sort of checked off a box. And then the other thing is Los Angeles is a rent control market. So you don't have free ability to, bring rents up.
Mm-hmm.
So there was a lot of buildings that had low cost per square foot and were in good neighborhoods, but the rents were really low, which meant you can't get any leverage on it. And, you don't have that much freedom. So I created this metric called leveraged cost per square foot. And I would basically assess what is my, we all say cost per square foot, and you're talking about the cost per square foot for the sales price. But I wanted to know what the cost per square foot I would pay after incorporating leverage.
Okay.
And so if I compared like 5 properties in a row side by side, the one that had the lowest cost per leveraged square foot would be the one that I would most likely buy.
Have you wanted to be part of GoBundance, the tribe of millionaires, but just haven't hit that millionaire status yet? Well, now you can, not even being a millionaire, by joining our new program, GoBundance Emerge. My name's Jamie Gruber, creator of GoBundance Emerge and member of the GoBundance community. And now you can join GoBundance.com/emerge, GoBundance.com/emerge. Use code Jordan for $100 off this 12-week goal-setting program and mastermind that'll propel you to being a whole life millionaire.
Awesome. And what Mark's talking about there is, with commercial financing, they look at how much debt can we give you based on what the property's making. So, you referenced rent control, Mark. If the rents are low and you're not making a ton of income, you can't boost that up. So you can't get high leverage on that property. Let's just use an example. They need it's $1 million property, but based on the rents, they can only loan you $600,000. So you have to bring $400,000 to buy this $1 million property. Whereas if the rents were good, they might be able to loan you 80%, which is $800,000. Then you only have to bring $200,000 to the table. That makes a big difference when you're going to buy multifamily property. Even if there's all this potential there, especially when you have rent control, you can't realize that very easily, but that affects what debt you can get. I think it's difficult to understand that if you only see it from a residential financing lens, because residential financing is just, hey, we're going to look at you, the person, and we're going to look at the property, make sure it's worth this, and we're going to loan you 75% of that total value.
Right.
So it's completely different. Yeah, I love that. So, Mark, you went 16 unit in LA is where we were last left off. What was next after that?
Let's see. So I had the market started getting a little rocky maybe by 2000, maybe like 2005. Mm-hmm. And yeah, I think I mentioned that there was a foreclosure that I bought my first foreclosure. It was a 4-unit. And then I think I bought a couple other, I think I bought a 6-unit and maybe an 8-unit. And then the next sort of significant thing is, and by the way, so what I was doing is I was going to work every day, and writing jokes and stuff. And I was telling everybody that I worked with, like, you got to get, you got to do something, do yourself a favor and invest in real estate, because you got to build some kind of financial cushion. This is a really volatile business, telling all my friends that, and, trying to get them to be smart with their money. And I think ultimately nobody would do it, to my surprise. And after a bit, they were like, well, you won't stop talking about this, so why don't you find a property and we'll go in on it with you. And so I started searching, and I found a property, another 16-unit building that in 2008. So by 2006, I was really wary of what was happening. And you could see the writing on the wall. Something bad was going to go down in the real estate space, given the really loose lending. And so I stopped buying. And then in 2008, the market slid and we started to hit this recession, and it went down about 10%, and then it plateaued. The market plateaued. And I thought, like, okay, I had been waiting for this. I wanted to see a correction. I wanted wanted the real estate market to shake off all this, inefficiency and issues that it had. And when I saw it go down, I started looking. I found a distressed seller. This was a partnership that everybody was suing each other over, and they were desperate to sell. And I locked in this property, which I thought was at a great price. Mm-hmm. But that was October of 2008. And right after we removed contingencies, Lehman Brothers collapsed, followed by Bear Stearns, and the whole world economy just plunged into, the deep recession. And what I had experienced is, I think there was like that was a little deceptive. That slide that I thought was the correction was actually just the beginning of a much more significant downturn. But anyway, I was like, oh crap, these are my friends. I see them every day. They're smart asses. They're never going to let me live this down. And, but took over, tried to do the best we could. And, ironically, it was like a B- C class workforce housing, in LA, and just kind of took it over. And it pretty much maintained throughout. At the only kind of hiccup we had during the downturn was the lender, which was a local lender that was discounting all of their portfolio, all of their loans, the properties based on the downturn. They had come to us and said, we want you to meet our debt coverage ratio, but we're discounting it due to the recession. And, you got to add a little bit more to your down payment. We did do that, but otherwise we held, we had the luxury of holding. During that recession, there was a lot of single family home foreclosures. So we saw people moving into apartments. And so we kind of held pretty steady, to my surprise, and it worked out.
Awesome. I want to talk about that real quick, because I know a few people who were buying pre-08 and held through 08 and were fine. It sounds like you did that. Did you have any losses through that time? Did you lose any properties?
No.
Okay.
No, knock on wood. Yeah. Everything went through. Everything went fine. I don't want to say I never had challenges or something, but 2008, we navigated it somehow.
Well, it sounds like you were doing your homework before you were buying properties too, and making sure that they were going to make sense and you can be able to cash flow and make money. And you had some upside there to turn them around and make them better.
Yeah. And I think, like you're saying, I think it was always, buying. I didn't buy really expensive properties. I didn't want to hang out there at the top end of the market. So it was always very much, workforce, B and C class with value add. And they had to have those, and they had to be in solid locations, solid submarkets. And those three combinations, they're always full.
Yeah. Yeah. People always need a place to live. So you mentioned warning signs. We're in 06, you started to see some stuff. What did you see that made you weary during that time?
I was reading about all the foreclosures that I think started possibly in Florida. And you were reading about this wave of like unprecedented foreclosures and defaults. And, the lending, what are those lending? They had a nickname for them, like no job, no ninja. Yeah. Right. That. And I remember being at a bar in like 2007, and some guy was there who was like part of our group, like a friend of a friend who was a loan broker, mm-hmm. who was just boasting about how much commissions he was making by slamming people into these loans that had no business qualifying these loans. And this guy kind of seemed a little bit like an idiot.
Yeah.
It's like, this guy is making money hand over fist. Like something's wrong.
Yeah.
But yeah, just this, I think the warning signs were there, very much there. I think, I remember I was a little bit shocked in 2011 and 2012 and 13, like, oh, nobody saw 2008 coming. Like, of course, everyone saw it. Anybody who paid attention saw it coming.
Yeah, I think that's interesting. And I think the questions everybody is going to have is, what do you think about right now? So I know everybody's saying, oh, this feels a lot like '06. Everything's going up so quickly. Prices are so high. Do you see any warning signs right now personally? And I know you don't have a crystal ball. Nobody does. Nobody knows what's going to happen in a month, much less a year or two. Yeah,
I wish I did have a strong take on it. This feels a lot different than 2008 to me. 2008, you knew that the banks, in order to gain more market share, had just way loosened their lending criteria, and they were lending to people who didn't have jobs, had no way of paying it back. And that was just a disaster waiting to happen. And at the same time, prices were surging upward. So you knew that was not going to end well. Nowadays, I think, I'm more worried about maybe the stock market, the stock market spiking, the single family house sector spiked due to the pandemic. And I can't tell if that's a cause for concern, or is it just that maybe the baby boomers are all buying houses now. Demographically, maybe there's some logical explanation that doesn't necessarily suggest we're headed towards disaster.
Yeah. I think what most everybody will say who's in the real estate industry, which you always want to take that with a grain of salt, myself included, I'm in the real estate industry, is there's a humongous demand, especially for places like Austin, where I am, and then for places outside of large metros, like, outside of LA, Orange County, outside of San Francisco. Once you get over to Sacramento, just going nuts. New York City has the same thing happening, but there's a tremendous demand all over the country. These places are not exclusive, and there's a very low supply. A lot of that is from builders can't build as fast as they need to. Prices of supplies are going up so quickly. Some people are still just scared to sell because of COVID. And then at the same time, interest rates are rock bottom. So Mark, you talked about a 7% interest rate. I had a client last year get a 2.25% interest rate.
Yeah, wow.
I've seen tons of them in the threes, just very, very appetizing rates. And that means people can pay more for houses. So
exactly,
going up and up. But like you said, we just don't know. We never know until we can look back and say, hey, that's what happened. That being said, there doesn't seem to be any signs of any sort of malplay or any issues. I'm sure that all of us at some point in time will look back and say, look what happened,
Right. Analysis in hindsight. I do think that, what could happen, like if you go across the board, like what are the potential events that could cause trouble? And one would be you mentioned interest rates are very low. If interest rates were to jump up, that would definitely impact the single family home space.
Yeah. Absolutely. Because every little bit your interest rate goes up, your payment goes up. So when your payment goes up, you can't afford as much. And when you can't afford as much, especially in markets like Austin or outside of LA, you might be priced out of the market. So like Mark's saying, that could be a chain reaction that could severely affect the market. If interest rates go up a point, which is a percentage point, that's a big deal. And that could hurt a lot of people's chances of buying a home. So real quick, Mark, I know we've talked a lot about just general real estate investing, your experience in LA after you got your job working at Family Guy. You've been doing that for a long time. When did you start to invest in Austin, and why Austin?
I had been building a portfolio in Los Angeles starting in 2000, and by somewhere around 2015, 16, I think I might have had 22 properties, 22 multifamily properties, ranging from, I think maybe a 7 or 8 unit to 36 units, 40 units. And, I had this growing thought that I need to get another market. I mean, LA has earthquakes. It's one city. I need to diversify. And so I wanted to look for a second city, a second market to invest in. And I was like, well, what's going to be the best market? What's the best market to invest in? I got a blank slate. I could go anywhere. I did want it to be not entirely across the country. I wanted a pretty easy flight. So I was doing research, and I had narrowed it down to Salt Lake City and Denver, or not Salt Lake City and Austin. And I was also looking at Denver, and I started analyzing properties, and I really liked Austin. And so I, started visiting, and I found a partner, and Nick Ameluxon.
Yep.
And we started collaborating, and we were vetting deals, underwriting them, and we ended up buying. We ended up buying like a 53 unit, followed by a 72 unit, followed by a 62 unit, I think it was. And then we've kind of continued from there, and we did one syndication. We did our first syndication not too long ago, but we had built our own portfolio prior to that and had been operating it. And I love the growth. Austin's a really amazing city. I think it's got some contrasts with California, and there are not everything is easy in Austin. There's tons of competition. The taxes are a little bit challenging. But as far as tech growth, tech job growth, population growth, all those things are kind of, you can't beat what's happening in Austin almost anywhere else.
Yeah.
And I think it's going to be a different city. Yeah. And you probably see this every day. Yeah. They're rebuilding the highways. They're rebuilding the airport to accommodate the growth. And I think 10 years from now, 15 years from now, it's going to be, a mega city.
Yeah. No, there's 40 plus towers in some stage of development. So they've just gotten their permits approved, where they've broken ground. Yeah, there's 40 plus towers, and that's citywide. So they're starting to span out. I know I'm on the east side. They're starting to talk about 40 plus story towers on the east side, and everything's a little ranch or duplex around here. And you're thinking, man, a 40-story tower down the street sounds pretty big. Let's hit the partner thing real quick. Your partner Nick's awesome. He's been on this podcast. How did you meet Nick?
I met Nick through Bigger Pockets. I think he might have reached out to me maybe after I did a podcast for them, and I think he reached out to me and asked, "Can I pick your brain?" And I always, I don't get flooded with that. So I try to get on the phone, and happy to talk with anybody if I can fit it into my schedule. And I talked to Nick, and I remember him, wanting to get into real estate and multifamily specifically. And I think he wanted to quit his day job. And we talked for a while, and I was just trying to answer his questions. And then right before he hung up, I was like, wait, you said you're in Austin, right? And I was like, and he's like, yeah, I live in Austin. I was like, oh, that's a market that I've been, it was right at the time when I was looking for that second market. I'm like, I'm looking in Austin, if you find anything, or if you want to, look for something together, let me know. And, we kind of hung up. And then I think, to his credit, he started sending me some deals, and we kind of doubled down and started vetting everything and making offers. And eventually, we landed, 3 properties, I think in 2019.
I love that. So I really like what you've done to get to where you are now, how you started buying all of your own properties before you even considered getting into syndication. I don't know if that was on purpose or that was just what happened.
Yeah, I was terrified to deal with other people's money.
Yeah, it sounds like you did a few JV deals before you did any sort of syndication. But that can be terrifying to deal with somebody else's money and have the possibility of losing somebody else's money. You start to think about, well, what about their family and their kids and their wife and all this stuff. But I really like people who have built up their own portfolio using their own money, risking their own life and everything, and then saying, hey, maybe now I'm ready to do this. I also like what you're doing with Nick here, because you are in LA, which is in a notoriously expensive market, hard to be a landlord in. And you said, hey, I need to diversify. I want to get out of LA. You found somebody kind of on accident in Austin and started investing with him here. And, I know when you have a partnership that's good, you can work together and make things happen quicker and easier than trying to do it on your own. Let's say you were trying to invest in Austin on your own. You might not have made progress as quickly as you have now. It can be great. Great partnerships can just blow up your business. I love that.
I agree. And I didn't know that for a long time. And I was oblivious and ignorant to that. I was kind of a lone wolf. Like I didn't know any other investors, didn't talk to any other investors. I talked to brokers. I knew all the brokers in town. I didn't know another investor. I knew, loan brokers and lenders. But the power of partnerships, and also just, it's fun. It's fun when you can bounce things off somebody. You don't get stuck as much. You don't, you don't second guess yourself as much when you've got someone to bounce things off of.
Yeah, no, it can make you move forward so much quicker. So you initially got started in LA, living in a duplex. It's a way a lot of people get started. Now you're investing in what I would say is medium-sized multifamily in Austin. And just for people listening, I don't know that there is any traditional qualifications for medium or large or small. I think small is 2 to 20 or 30 units. Medium size maybe being 30 to 75, and 75 or 100 plus, I would call large multifamily. Again, I don't know that there is any specifications for those things. So you already kind of talked about, what attracted you to real estate. You had what seemed like at the time an uncertain job, although Family Guy has been going for decades now and doesn't show any signs of slowing down. Could you tell us about a bad deal you did, or advice on how to avoid a bad deal and how you did so?
Hey guys, this is Jordan Moorhead here, and I wanted to ask if you could do a huge favor for me. If you could go leave a review for this podcast wherever you're listening to it, that would really help me get this into the hands of other people that are interested in information about Austin real estate investing, and I'd be able to help more people. Thanks, guys.
Sure. And by the way, Family Guy did get canceled twice while I owned that duplex.
Oh, really?
It took us a while to get off the ground. I think we had one stretch that was 2 years. We were off the air for 2 years. Really?
I did not know that. I guess I've been watching it off and on the whole time, but didn't realize it canceled for a while.
Yeah. In 2002, we were getting terrible ratings, and Fox pulled the plug. And miraculously, that same year, they put out the Family Guy box set of DVDs, and pretty remarkably, it was the number one selling box set of DVDs, and the show was canceled. and so they started to like reconsider it, and then a brilliant move by the president of 20th Century Fox, his name is Gary Newman, is he offered to give Adult Swim the episodes, the sort of bank of episodes we had on Family Guy for free. And this is their competitor. And he said, you can have these episodes for free. You could put them on at 11 o'clock at night, Adult Swim, you're looking for programming, and no charge. But if the ratings, after a year, if it's getting good ratings, we have to have a conversation.
Oh, and cool.
That's what happened. And it was beating. And at the time, like, you may not remember this, but there was those late night wars between Leno and Letterman, and everybody was getting into the late night fray. But Family Guy reruns, they were not original programming, was the highest rated show every single night of the week. And that's what kind of caused them to bring us back.
Oh, that's awesome. I did not know that. That's a cool history there. So I want to touch on one thing here, real quick. Back to the about a bad deal or advice on how.
Oh, sure, yeah, of course.
Deal.
Yeah. Let's see, a bad deal. I have been very fortunate that I have not had a losing deal in multifamily, and I don't even think I've had rough stretches on deals. Like, last year we just had one property that had, nothing came up on the inspections, but then we found mold, and it became this, like, we had to relocate, 6 tenants for a couple months. But then we resolved it. I have challenging deals. But yeah, I will say, and this is, I feel like I'm a minority in the multifamily space, that I don't go for cash flow, and I don't go to, the middle of the country. And I'm from Ohio and love Ohio. That's where my heart is. But I have always prioritized strong markets and value add, and just be careful. And low cost per square foot contributes to that. I think when you're going in, at half of the cost per square foot than it costs to rebuild that new construction, I think you're just protected.
Yeah.
And then you add value. You put in your money then after you take over, and you invest money to bring that up to hopefully compete. It'll never compete with newer product, totally, but you could make it, you grab these old buildings from the 30s and 20s, amazing architecture, and some people want to live in those, almost prefer those because of the character.
Yep. Yeah, absolutely. I hear that a lot, actually. So I like what you've done too, because you've always kept your job. I'm kind of assuming because you've enjoyed your job. I'm sure if you didn't want to work anymore, you didn't have to, but probably like what you do and take advantage of that. I really like that too. A lot of people get into real estate to want to get out of working. I encourage people to find something that gives them energy that they like doing. Keep doing that. That's going to give you much more money to invest in real estate, and then just give you unlimited options if you keep doing that. So I just wanted to give you props for that. I really think you've done that. I don't think that anybody'd be happy not doing anything.
I think, if you can do what you love, and it's easier said than done. A lot of things that you start out loving become a headache when you've done them for a long time. But also, I'm a believer. I don't think I've ever told anybody, "Hey, invest in real estate for a year and then quit your job," because the thing is, the reality is that everybody has life changes, and you may decide to retire at age 28 or 29 because you've got a couple properties, but then kids come along, you get married and you get kids and you get tuitions, your whole economic world changes and spirals upward in cost. And so I don't know, to be conservative, find something you like doing and keep making money at that.
Yeah. And I think as you've kind of shown people, if you also do that, you can be in a position where you can take advantage when there's deals out there and not lose properties you have. So if you're not relying on all of your income to pay your bills from your real estate, and you've got a job going that makes enough for you to be happy and comfortable, you can be more aggressive with the real estate and take advantage when you're able to.
Yeah, I think you're right with that. That's a great point. And I think additionally, and it also allows you to not be so heavily reliant on cash flow. Mm-hmm. Because I think I'm a believer in invest in the strongest markets. Mm-hmm. Don't focus on cash flow. Go for the best markets, the markets that are growing, have job growth, population growth, income growth. Mm-hmm. And that's where you're going to do best. Because, the eternal maxim of real estate investing is not cash flow. It's location. Get in a great location, and you're going to have to sacrifice cash flow in great locations. Austin, you've probably observed the cash flow dry up over the last 5 years as the competition increases, but you'll get the highest overall returns if you can focus on on great markets, growing markets, and do a little bit of both. Go for total return rather than exclusively cash flow.
Yeah, I want to talk about that real quick too. So I think everybody looks at it through the cash flow lens. I get people all day saying, well, this property doesn't cash flow. It didn't, like you said, over the last couple of years, maybe decade in Austin, excluding some early times there in the last decade, it's been really hard to find cash flow here. But even if you bought last year in a good location and added value to the property, you made a ton of money. So the property I'm actually sitting in last year, I bought it in July, didn't make a ton of sense from a cash flow perspective. But I said, hey, this works. It's going to make money. It's going to pay all the bills. It's going to be safe. It appreciated roughly 30% in the last year, which is wild. And of course, I added some value, but that's huge.
And probably had leverage as well, which amplified that 30% to maybe double that or triple that?
Yeah, exactly. A lot more. Yeah. Strong leverage. And I think there is so much more to real estate investing than just cash flow. I absolutely believe in cash flow. I think that's a great thing. So when you're looking at an investment, let's say you're looking at a 16-unit apartment building, do you have any metrics you try to hit?
Do I?
Yeah.
I would always want a 5 cap.
Mm-hmm.
5 cap was like, for example, in my criteria is different in every market.
Sure.
But for example, in LA, which is like, I've had the same criteria for the longest time. It's simply, I want to buy at $250 a square foot or less because it costs $500 per square foot to build a new product. And the average of LA is probably around 400, of all inventory. So I want to be way below that. And then I want to combine, way below that on a cost per square foot. I also want a 5 cap because, in a market like LA, where it's kind of an A in terms of lenders' eyes, it's an A location. So it's a strong location. So you can get good leverage on a 5 cap. You could get 75%. And then, beyond that, value add. I think the low cost per square foot is going to suggest that there's going to be a value add because you're buying, probably an old property and probably a not updated property. And then great locations. Always find the hottest, find a great city, a great market, and then find a great sub-market.
And When you mention that, management comes to mind. Do you find management is easier in a great location rather than a not so great location? And did you come to that conclusion out of experience or just because you like good locations?
I just like good locations. I wouldn't say management as far as third party. I don't know if you're talking about third party property management.
Yep.
I think third party property management. Yeah, I think it's a mixed bag. I think you gotta, unfortunately, you've got to watch your third party property manager, and you've got to set clear criteria. I mean, it's a hard job. It's a thankless job. But I think you get neglect in almost anywhere. I've never seen, I've worked with some great property managers, thankfully, but I've also sifted through a number of bad, a number of subpar property managers or ones that tried, they just weren't equipped to, operate at the level that I wanted them to.
So, yeah, no, I absolutely. Third-party property management doesn't just mean you give it to them and never think about it again. I know that's the thought, but in reality, you give it to them, you need to work with them, make sure everything's going well. And then you can take your foot off the gas a little bit when things are running smoothly and you're seeing that they're doing the job you want them to do, but you still want to check in every so often with them.
Yeah. And, just a quick insert, Nick. So when Nick, when Nick and I started talking, he wanted to quit his job. And one of the things I said, how about maybe there's an arrangement that we could get a win-win is maybe I'll pay you if you want to come on and be my asset manager and just create, measures in performance, standards for all of the properties across my portfolio. And so he became my property manager or my asset manager and, really stayed on top of that stuff. And it was a win-win, it was like he got to leave his job and I got, another set of eyes watching, the 3 property management companies I was using at the time.
Oh, cool. Yeah, he's got that personality. So I could see him being really good at that.
An engineer. Yeah.
Yeah, absolutely. Very systematic. Mark, what's one thing you would tell a newer investor looking to get started? So you've been investing for 20 plus years now across multiple markets. You've house hacked. You've stayed in the multifamily lane after that. What would you tell somebody that's just looking to get started today, let's say in Austin?
In Austin. Okay. I would tell somebody starting in Austin, I'm a syndicator, but I would not say join a syndication. I think the best deal out there is house hacking. If you can buy a duplex and fix it up and take advantage of that FHA loan that first time, it basically much of it boils down to the opportunity as a first time buyer to get like a 5% loan, 5% down payment loan. Gives you phenomenal leverage. So if you can raise, if you could increase the value of it by 20 grand, at 5% down, that's 20 times that 20 grand. So, you just went to, was that 400,000? Your $20,000 gain became $400,000 of gain. It's just really, you're in a position to have really powerful leverage and just make sure your value isn't going to go backwards.
Yeah. Yeah. And I think that, there's so many benefits to house hacking too. Not only do you get this amazing leverage, but you also save so much money every month. You can save some money on your taxes. You get that appreciation. You can get some cash flow, like you said. You just get so much of everything with that amazing leverage. And I think that's overlooked so often. I'm not going to get this great cash flow. And I think if somebody went back to you now and said, well, you could put down 3.5%, you're probably going to be a 4 or 5 cap. That looks a lot more attractive than having put down 25%.
Yeah. Yeah. And I, like you saying, you're completely right. one thing I remember about living in that duplex when I bought this duplex, thought I had made this mistake, is I was always fretting living in that thing. I was always fretting about like the dishwasher that broke next door in Mike Henry's my friend's kitchen, and it was going to cost me like $250 to replace. And I was like, oh man, like what a mistake this was to buy this duplex. But what I totally was not aware of is I was not aware of the appreciation that was happening. I had my loan on, auto pay down. I was oblivious to the principal that was getting paid down every month. I was oblivious to the momentum of the market that was increasing the value. And I was oblivious to the fact that I had a 10x leverage. I had 10% down. So every time, the building went up in value by $10,000, I made $100,000. Mm-hmm. There's all these invisible forces. And those things are, it's appreciation, it's rent growth, it's depreciation. I was totally oblivious to depreciation, but you had all these benefits from that as well. And loan pay down. Those are just a few of them, but they're all working in your favor and combined, really powerful.
Yeah, I think the old saying is buy real estate and wait, not wait to buy real estate. I really like what you're saying there. So there's so many forces working in your favor, but you really don't realize them until a lot further down the road, until you made $800,000 off the first property you bought. Like you said, you thought every day, this is the worst decision ever. I'm going to lose all my money, which logically doesn't make a lot of sense, but it's very easy to think that way. Think, I put down that huge chunk of money. That was all the money I had. I'm going to lose it all. But really, are you? How do you lose it when you're on a 30-year loan with principal and interest payments that are just automatically coming out of your bank account each month, and your taxes and insurance are escrowed? You don't have to do anything. It's so sweet. You have a lot of commercial loans. They're not as sweet. Right. 30-year loans are awesome.
Yeah, definitely. And you're, part of your original question was, what would you do if you're in Austin starting out? Mm-hmm. And I think in a city like Austin, you're so, it's going to be really hard. It's going to be competitive buying, but you're going to see great growth because Austin's still got a ton of growth ahead of it, as opposed to, one thing I notice on, for example, like the Bigger Pockets has I don't know, it's been a while since I looked at it, but it had like the best markets, and it said, and it measured by cash flow, and the top 2 or 3 markets were Flint, Michigan, and Youngstown, Ohio, and I grew up near Youngstown, Ohio, and there's no jobs in Youngstown, Ohio. The population is declining. Flint, Michigan is not one of the best economically. So, you're in Austin, you're the opposite of that. Like, beware of chasing cash flow, because you're going to get the best cash flow in the worst city, like mathematically or logically, because cash flow is a function of demand. And so you're in Austin, it's going to be competitive, but you're going to do well if you can get in and stay in a market like Austin.
Yeah, I love that. You got to get in, but then you have to stay in too. Mark, you've been investing for 20 plus years. It sounds like you're very well versed. You didn't start meeting other investors until 6 years in. So were you reading and consuming content that way before that?
Yeah, I was reading books. I was reading every book that I could on real estate and a little bit of real estate taxation, but just trying to figure it out. And I would talk to brokers a lot. I became friends with a lot of brokers and, would pick their brains about stuff.
Awesome. So what's your favorite business or mindset book if you're just going to recommend one to people?
One that I'm reading just recently is, I think it's called The 21 Irrefutable Laws of Leadership by John Maxwell.
Mm-hmm. Yeah.
And I hadn't, it's been like a gap in my education is I've read a lot of real estate books, a lot of business books, but, I'm a little bit fixated lately on leadership, and it's fascinating. It's a fascinating sort of arena and how powerful it is when leadership is good.
Yeah, and I think that's one of those things that really ties into doing well in real estate is when you've got great communication skills and you can be a good leader. Obviously, you're going to be more successful as a real estate investor. Before we started here, you and I were talking a little bit about habits. I think habits are the same way there. If your habits are great in your fitness life, if you eat well, you get up every day, you exercise, you're going to be in good shape. But if you've got great leadership skills, great communication skills, and you have the habits necessary to keep improving those, your real estate investing is just going to get better.
Yeah.
I love that.
Yeah.
Stuff.
But I always think like trade your indulgences for disciplines, trade your vices for virtues. Like, yeah, we all kind of drift through life. And if we're not paying attention or mindful about what we're doing, we're going to pick up a ton of bad habits.
Yeah.
So be aware of what you're doing over and over again, and you're reinforcing.
Yeah, I love that. I also, you and I met through GoBundance. I think it's very important to get around other people who are also trying to improve themselves so they can add to you and you can add to them and you can just all get better together. This old saying,
I like that.
The sum of the 5 people you're around. So make sure you're around people that are pushing you and helping you grow and helping you be better every day. And be a good leader to the people you're around every day. Just being a good leader a lot of times can be setting a great example. I love that stuff.
Right.
All right, Mark, we're getting towards the end here. What's the best way for people to get a hold of you or to learn more about what you're doing here in Austin?
Sure. You could check out our website, which is quantumcapitalinc.com, or you could send me an email at mark@quantumcapitalinc.com.
Okay.
And, I have a podcast as well. You could check out, it's called the Wild West Real Estate Podcast.
Yep.
You were a guest on it.
Yeah. Great show.
Excellent job.
Awesome. Yeah. So guys, we will have all that in the show notes here too. So when we publish this podcast, which will be in a few weeks from now, you'll be able to find all that in the show notes. Mark, last question, the most important question we ask here on my podcast, Austin Real Estate Investing Show. What is your favorite restaurant in Austin?
I
know you're in LA, but I know you come here. I know you eat.
Let me see. El Alma?
El Alma. Okay.
Do you know that one?
I do. Yeah. I think
I just texted Nick. I said, where do we go to eat every time we're there?
Go with him.
Right.
Yeah. I know he loves El Alma. Now there's so many good restaurants around here. It's hard to choose a bad one, but it's always good to have good recommendations. So
absolutely.
Check out El Alma, guys. All right.
Cool. Mark. Thanks.
Yeah. Thank you so much for coming on here today.
Thanks for having me.
You want to reach out to Mark, it's quantumcapitalinc.com.
All right. Thanks, Jordan.
Thank you.